If any of you have been to a waiting room at a doctor's office in Barbados, you will know that things can take a very long time. So when you get an appointment in a doctor's office in Barbados, that doesn't actually mean that's when you're going to be seen by the doctor. All that means is the person who's got the late appointments coming after you and the person who's got the early appointments coming before you. So that's the same way you must read the agenda that we have today. So we are still technically, I think, at 12:15 p.m. And we are going to be starting the session. Sanjay is going to be working on talking to you about building back better. So there was much talk earlier about this trade-off between can we insure something, is it insurable, is the alternative building resiliently so that we don't have destruction that needs to be insured, or at least we minimize some of the loss and damage because we've built better. So can it be done? How would we do it? And how expensive is it? Sanjay.
Thanks, Avi. I think Oldham is one minister, so ministers of the Caribbean, distinguished guests, good afternoon all. I was going to say earlier on that I was lucky because I was presenting before lunch, but Avi, you managed to make me present after lunch, which is possibly the worst time for everybody. But anyway, good afternoon, everybody. My topic today is on the cost of building back better. So I'm going to tell you, I think most of you probably don't know who I am, apart from the Bajans. Let's tell you a little bit about BC Kiosks on a couple of slides, and then focus on what it means to build back better, and then followed by the cost to build back better. About BC Kiosks, so we're one of the, if I can use that word, largest independent property and development construction advisory, real estate advisory companies in the Caribbean. Our core service include project management, construction management, quantity surveying, project monitoring, valuations, and feasibility studies for clients. We have 13 offices throughout the Caribbean, as noted above, as well, and that includes an office in São Paulo and Bogota. But we operate in all the Caribbean countries apart from the French countries. So we operate mostly in the English-speaking, some Spanish-speaking. We've done work in Dominican Republic, we've done some stuff in Haiti as well. But otherwise, and of course the Dutch islands. So, to the presentation. What are the main losses following a natural disaster? I think pretty obvious. Infrastructure is roads, sewage, electricity, water, which are utilities. Damage to homes, commercial buildings, government, civic buildings, which would include hospitals, schools, and the like. So building back better, that's the topic today. What does it mean to build back better? And I have a slide there which says, achieving resilience through stronger, faster, and more inclusive post-disaster reconstruction. So building back stronger means that reconstructed infrastructure and homes, as well as other buildings, can resist intense events in the future. I think we heard some presenters talk about that earlier on. According to a World Bank report, if all countries were to build back stronger in the next 20 years, ensuring that rebuilt assets can resist hazards within a 50-year return period, then global well-being losses due to natural disasters would be reduced by 12%, a gain equivalent to about 65 billion annually. Now that percentage gain would be much higher in smaller islands such as Barbados. Building back faster. Building back faster reduces the impact of the disaster on individual islands and countries. And this can be achieved by having full and proper contingent reconstruction plans, as well as financial arrangements, which again we heard about today, and I think you'll all agree that the latter is always a challenge for us in the Caribbean. Just as an example, one of the countries we operate from is the Cayman Islands, and I always remember the reconstruction effort post-Hurricane Ivan in September 2004. The damage principally being done by storm surge. However, after the hurricane passed, the private sector, in conjunction with the Cayman Islands government, drove the reconstruction effort by forming what they called a bipartisan committee, and most businesses were back up and running within 3 months, which was pretty impressive at the time. The key point to note here is the involvement of the private sector, who I'm advised also put up a considerable amount of money to get businesses back up and running. As a matter of interest, I was there a few months ago, and noticed that utilities in several new developments are now being placed underground, and that new homes are now being built 1 to 2 meters higher than the ground level, so that when the storm surge does come back, they'll all be good to go. Inclusive. I think we're building back more inclusively. I think we heard some people talk about, some of the presenters talking about that earlier on. Building back more inclusively means that support must reach all affected population groups. Very important. There's a big problem in many Caribbean countries. I mean, you have to look at Haiti or even more recently Bahamas. I'm advised that the population worst affected by the storm surge in Grand Bahama were the low-income households. Similarly, the reconstruction effort since Irma in September 2017 in the BVI and St. Martin has not progressed at the same speed for low-income households. So how do we build back better? Important to have recovery plans in place based on priorities and activities in existing development strategies. Investment in infrastructure is critical, ensuring there is minimum disruption to telecommunications, power, water supplies, as well as roads after the natural disaster. Now, flooding is something that's a common occurrence that's happening nowadays as well. Next one is creating transparent and accountable processes and including all the stakeholders. In this regard, building back better must involve all the stakeholders. This would include local civil society organizations, as well as government, private sector, regional and international agencies to ensure transparency and accountability. Earlier, I gave a positive example of what happened in the Cayman Islands after Hurricane Ivan. Here is not such a positive example. And if you can remember what happened in Haiti post-September 2010, post the 2010 earthquake, in my opinion, probably 10% of the amount donated was physically distributed or used, and probably 50% or less of that amount was actually spent towards building back better. Haiti today is unfortunately still challenged. Closer to home, I believe that the recovery plans for the BVI and Dominica are trying to ensure that these participating processes are being followed. Ability to withstand shocks by building to standards and codes. Majority of countries in the Caribbean do have building codes or standards in place, but don't enforce them for a variety of reasons. It's critical that building standards are improved with emphasis on a highly skilled workforce, as well as enforcement of these standards by design professionals, including architects and engineers. This next slide is really a data slide, just showing you the 5 costliest hurricanes in the Caribbean. You can see at the top there, I think there was some information that was provided earlier on. Hurricane Irma there affected 16 countries with overall losses of 67 billion and insured losses of 32 billion. Fatalities again there, 128. Hurricane Maria was the next one, following straight after that. Again, Hurricane Maria affected 9 countries, overall losses of 63 billion, insured losses of 30 billion, and 108 fatalities. Hurricane Georges, it was some time ago, affected 7 countries there, 14.7 billion losses, and insured losses of just 3.8. That was a long time ago. But the worst thing at that time, of course, was the fatalities, which were over 3,500. Hurricane Ike, western part of the Caribbean, 7.6 billion losses, and look at that, insured losses, 39 million, with fatalities at 82. And then, of course, Hurricane Ivan, which I spoke about earlier on, that was 10 countries, just missed Barbados, and luckily for us, and went on to Grenada. 5.9 billion losses, with insured losses of just 2.3 billion. As you can see, apart from the loss of life, which is tragic and the worst part of a natural disaster, the insured losses are less than half the overall losses, which means that most of the built environment is underinsured. And as I said earlier on, I think it's incumbent upon insurance companies or lending agencies to ensure that replacement cost assessments are undertaken for all their insured properties. Real estate must be adequately insured in vulnerable countries, and perhaps the insurance industry may need to partner with governments and development banks to provide greater assistance to countries in the Caribbean. Also remember, and I can't remember, it was at one of these financial conferences, and one of the presenters said that 80% of the world's wealth is in real estate. So that tells us a lot about where we should be. I'd just now like to highlight what's happening in the small island developing, we've talked about small island developing states in the Caribbean and closer to us in Barbados. SIDS have been at the forefront of the fight against the devastating impacts of climate change, experiencing hurricanes, tropical storms, storm surges, and floods at a higher frequency than most countries. And often when we are hit, a large part of our population and assets are affected, with the 2017 hurricane season being a classic illustration of this. There is, of course, a higher risk due to concentration of assets, with recent examples in the BVI, St. Martin, Dominica, and Barbuda. In larger countries, for example, recent cyclone in Japan, only a small part of the country was affected, and they weathered the storm, so to speak. But in our case, due to concentration of assets, the whole country becomes paralyzed for a long period of time. The other point to note is that resilience in some cases is related to GDP per capita or financial well-being. And the case in point is the Turks and Caicos, Cayman Islands, and Bermuda seem to weather these storms much better than many of our other countries. That's just some data there on BVI, what happened there. I lived there for 10 years. 7,000 homes destroyed, roads, homes, building, just total destruction, economic loss of 3.6 billion, small population of 32,000. 2 years later, homeowners are still building back their homes. In fact, I spoke to our office manager 2 days ago, and she was telling me that she's very busy because she's building back her home. And I said, why so late? And she just said, well, number one, she admitted she was underinsured. Number two, the insurance company took some time to pay. But this is like 2 years later, and she's now finishing her home. So, BVI is still taking a long time to get back, as is St. Martin. And then, same in the BVI, not enough enforcement of building regulations. They do have building regs in place, but the enforcement just isn't there. And so that becomes a challenge as well. That's just Haiti's earthquake. I was actually there before 2010, in 2009, on a voluntary mission with Habitat for Humanity and the Royal Institution of Chartered Surveyors, and we presented to Public Works and several government agencies just talking about what would happen in case of a disaster. And we were in Public Works building, and I said, you realize this building would not survive an earthquake or a hurricane. And unfortunately, in January, we had that earthquake, which was terrible, probably the worst, well, it was the worst catastrophe in modern history. So, on to the specialist topic, the cost to build back better. So what we did here was we took 20 homes, typical homes, and analyzed what percentage of cost would be for various elements in a building. So you'd see foundations, 12% frame, external walls, 12% roof and roof curving, 16. I mean, there could be ranges, but I just thought we'd try and make it add up to 100% so it would make sense. Internal walls and finishes, 22%, fixtures and finishes, 8%, and air conditioning, electrical, and plumbing at 20%. So that total. So the extra over cost is that column, which is a key thing, really. The cost to build back foundations is really in the increased amount of reinforcement bars required. So there's no massive increase in cost, but it does add to 1 to 2%, because that's all it is. To build to Zone 4 standards, which is California Bearing Ratio, they call it the CBR ratio, it's increased in reinforcement bars for foundations. In Barbados, I note that engineers are increasingly specifying 4,000 PSI concrete, which is higher than what it used to be, but this is all for a good reason. The frame and external walls, again, that's what you're talking about, is the columns with additional reinforcement bars again, and then the blockwork infill, so that previously we were probably doing every 3-foot centers, whereas now we're doing 2-foot centers with concrete infill. And that's principally for earthquake reasons. But again, doesn't add that 1 to 2% of total cost. Roof and roof covering, that's important, of course, because we, invariably in hurricane conditions, we're losing a roof. But assuming a sloping roof, the extra cost is in the hurricane straps and ties, as well as other fixings. In some cases, rafters are now being fixed closer than 2-foot centers, but mostly, typically, certainly in Barbados and some of the other countries, we're still at 2-foot centers. Standing seam is preferred to shingles, since the condition of shingles deteriorate over a period of time and are easily lifted by gale force winds if not fixed properly. The next big one there really is doors and windows, and that's mainly because it's a big ticket item. Standard glazed doors and windows range in price from $15 to $30 per square foot in most countries, depending on where you are. But if you are going to work to Dade County standards, which is to withstand Cat 5 winds at debris coming in at 150 miles per hour, debris coming in and hitting the window, then your cost started around $50 to $60 a foot. And that's why that particular cost adds 8%. So in totality, if you were going to be totally earthquake proof and hurricane resistant proof, it would probably add between 12 to 16% to your home. The alternative for doors and windows is that you use shutters. So it does depend on how you decide to do that. Right. Let's have a look at this. Am I using the wrong thing? What happened? Could you do the next slide for me, please? That's just, again, a commercial building, 5-story commercial building, looking at it similarly. Percentage costs there range from 8 to 24% for various, obviously, in the mechanical, electrical, plumbing, you would get, you have elevators and fire protection systems, so that's why the cost there is a bit higher. Again, foundations, it's mainly in reinforcement bars again. Frame external walls, the same sort of thing. Upper floors, you introduce upper floors in here. So you probably have, if you have a 5-story, you have 4 upper floor slabs. Roof and roof covering, just one roof, one slab, so that just adds 1%. Again, depending on the extent of glazing you have in an office building, it can add 8 to 10%, possibly less if you have less glazing. But then, if you are doing a commercial building, you want to maximize your glazing so that you think, you need to have tenants who want light and things. So, again, for office buildings, the extra over cost is anything between 12 to 17%. Other costs to consider, again, most people don't really, certainly not in Barbados, have generators. I think in other countries they do have, certainly we're working in Guyana and most homes, not most, but a lot of homes do have generators because of the frequency of power outages. The generators would cost for a home typically between $3,000 to $10,000. These are all US, depending on what you want powered up. Similarly, for an office building, anything from $30,000 to $100,000 for commercial buildings, again, depending on size and capacity and what you want powered up. Portable water tank or cisterns, I just think everybody should have one of those because it's just like no matter which part of the Caribbean you're in, you should always have a backup water supply because that's, you can live without electricity, but without water is always a challenge. It's about $1,000 here for a small tank. Cisterns, cisterns are typically more prevalent in places like the BVI, St. Martin, where you don't have town water. That's, you would build those for $2 a gallon underground. In some countries where there's the cisterns are built up to 5,000 gallons or more. So, where you're using cistern water only, you probably do 5,000 gallons or more, and that would add $10,000 to your overall budget. Large cisterns for commercial buildings in Barbados, they insist on, in fact, it's law now. I think the planners actually insist on having either underground tanks or overground tanks. But you've got to put, I think it's about 4 gallons per square foot of roof area. And so they're insisting on having backup water supply for all commercial buildings. In summary, what should we do to build back better? Improve building standards and make them mandatory. Enforce building codes. Have effective and well thought out disaster management plans in place, including an electrical resilience plan. If possible, have financial contingency arrangements in place, and I think we've heard lots on that today already. And then employ innovative technology, ensuring minimum disruption to telecommunications services. I just thought I'd add that slide for Barbados as to whether we're really well prepared for a Cat 5. I know that we're actually in a Cat 3 zone. Barbados National Code makes us designed for Category 3 winds. Are we really well prepared for a big hit. Thank you.
Thank you very much, Sanjay. I was quite struck about how low the additional costs are. I mean, 12 to 17%. Surely we could just change the building codes and see if people can pay that extra over some time.
Well, see, it depends what your starting point is. Because if your starting point has to be that you're building to a certain standard already. So the extra over to build to earthquake standards means that you now put it, so you're assuming that you're building to a code, but if you're building that to that extra over, which is to comply with earthquake standards, then you need additional rebar, you need it within the foundations and slabs. A lot of people, we just talked about it, if you're going to use 2,000 PSI concrete, then yeah, you're not going, you're assuming that they're using the right standard of concrete. So that's probably the reason why you said that.
Got it. So it's 12 to 17% over a level they're not actually at yet.
Yeah. I mean, in Barbados, we're building here and I'll speak in US dollars because I think most of you will understand that. A typical home here in Barbados costs around between 100 and 120 US a foot to build. Not, not low income. We have low income-ish. It would starting at around 100 to 120 US a foot, and then you're going upwards from that. Trinidad would be lower. Trinidad would be around $80, 80-ish. Guyana's even lower. Guyana's much lower. But it's whether they're actually built. In Guyana, they don't need to build to the same level as we do. And obviously, our sort of price point is higher here as well.
And you didn't, you weren't too explicit about how much resilience does that buy you. So I spend 20% more. What can I withstand extra? So
you're withstanding. If everything is built properly, in other words, your straps, your roof coverings, and you should be able to withstand an earthquake, as well as the hurricane, because you're technically speaking, what you've got is windows that are supposed to withstand Category 5, and roofs that are not supposed to get blown off. Now, in the BVI, people had windows that were Dade County compliant, but if the fixings were not done properly, what happened is they got blown in or blown out. So it does, it really is. It's a technical thing as well. That's why we talk about highly skilled professionals. You've got to have the right. It's one thing buying something that's Dade County compliant, but if the people who are fixing them don't really know how to fix them, or it's not fixed properly in accordance to the manufacturer's instructions, then the wind's going to come through somehow and just pull out the window or take up the roof.
Question over there.
Well, certainly the insurance, it's not incumbent upon the insurance industry to do that. It's a good point. Really, Philip Temper was here earlier on from Jada Construction. It really is upon people like them, and I would like to say that in Barbados we have some very skilled professionals here. We do build well. Nothing against Trinidad, but you do find a few, not I'm going to use the word cowboys, but you do find a few more cowboys there than you would here. The guys here, even the professionals here, really, we have some really good Trinidad professionals are good as well, but at the same time, it's not, we just seem to, I don't know what, maybe it's historically, over 30 years, the education, I just don't know. But I don't think you'd expect the insurance to answer your question.
Chair.
Yeah, the contractors. It is. I would say it's more upon the construction industry. We don't. Well, certainly in Barbados, like Trinidad, you have a very good contractors industry. You have a good contractors association. Everybody works together to try and do things. We don't seem to have contractors. Well, there is one, but I just don't think it's active enough that and disseminates out good building practices as they should do.
Great, Daniel.
Yeah, thanks, Chair. I'd like to agree with the presenter on a number of areas. Having worked in just about every country in this region, I think we have a fair equal distribution of cowboys across the island chain. But in terms of the training, which I think is a fantastic point, what we've been doing at CDB is we recognize that the average homeowner across the region unfortunately can't or has not been able to afford to go to a bona fide contractor, right, who may be a member of a contractors association. I do think we have fantastic contractors associations in all of our countries. What they do is they go to the uncle or the father-in-law or somebody to help put back on the roof, etc. And it is important to train these artisans in what would be considered best practices for our region. And so we've undertaken at CDB, we funded quite a few interventions at training and upskilling artisans, builders, contractors, small contractors, to build in accordance with the requisite building codes and standards, incorporating the incremental improvements to enhance resilience in the built environment.
That's amazing. That's very. I wasn't aware of that, but that's super.
We've done it in the OECS. We've done it on about three occasions in the OECS, and we continue to roll it out across the Caribbean.
Great, thank you, Daniel. Flores.
Thanks, Flores from the IB. Thanks for the presentation. I have a question that I heard that following a disaster that normally because a lot of the port infrastructure is also being hit, the cost of construction materials goes to the roof. So what can a country do to prepare for that, or what mitigating actions are there? Because like it makes so much logic like this, but the reality after the storm, of course, is very different.
Yes, correct. I mean, building back stronger, but when you're trying to build back faster, materials do go through the roof. I mean, after the hurricane in New Orleans, if you remember, or not, well, they had the hurricane. And the building materials here went up by 15% because of what was happening in the States. Just as an example. So the same thing here. What happens is St. Martin, classic example. I mean, St. Martin costs. I was giving you examples of building homes and things. St. Martin costs were probably around, same $80, $90 a foot to build a typical average home and things. Since that hurricane, they've gone up. And that's mainly because labor, it's difficult to find labor because, there's demand for it, and then the materials as well. So the challenge really is, number one, you can get the materials in. Well, it's actually, the challenge is also getting the materials in Dominica. The port was almost shut. So it's about, it becomes, because it's small islands, it's about who you know. So, you make the call to the guy there and say, look, can you get my container out as quickly as you can? And so it becomes more about who you know, sort of thing. And so it's very challenging for governments or ports authorities or because most of our building materials are imported. So it becomes supply and demand takes over, and prices do end up going up, both labor and materials. It's very difficult. I mean, the same thing happened in the States as well, right? I mean, you got a big United States that economy, and prices shot up straight after that hurricane because everything was going to that part of the world, to New Orleans.
I think there's actually a more general point there, because it's not just construction materials. Most of our countries after the hurricane had need for large clearing equipment that would not normally be available at home, and they needed to import it. And there was a tremendous amount of what some people might call price gouging that took place because they were desperately in need, and those equipment wasn't around. That equipment wasn't around. So is there a possibility for entering into contingent contracts before the hurricane, where you pay a small amount to guarantee delivery of critical things at the time of a crisis?
See, when you involve all stakeholders, that's the sort of question that will be raised. And if you plan for something like that, then possibly. But again, the reality is that when you go to Joe Bloggs for his backhoe or excavator to clear those gutters and things outside your house, market forces seem to take over.
Tessie?
So thank you for this presentation. I think you've raised extremely operationally relevant points. We are, as you know, that the World Bank is also was asked by the Netherlands to administer the trust fund for the reconstruction and recovery of St. Martin. St. Martin is not a member country of the World Bank, but the special request was made to the bank, and this is like $550 million of trust fund, which is for the Dutch side of St. Martin Island, 40,000+ population. And these issues that you highlighted are really critical ones. I mean, Evie, the point you made about the debris removal and those kind of equipments, that's one. But then after a while, the reconstruction has to begin, the housing, the roofing, the shelters, etc. And there is such a problem of, getting responsive bids.
Correct. You
what
can't even get contractors to
It's
bid.
just very difficult, and that's an issue that we don't have an answer for, but I'm just putting it on the table that does delay the recovery process, reconstruction process. Second is that with the, I don't know if anyone from CDB, with CDB and the World Bank have been trying to work together to look at emergency procurement in a way, having a roster of potential availability, what you mentioned, Avi, something on that side. But I don't know, if I'm not fully briefed currently, but I'll check on it, whether it does include construction side or it's more on the softer side of the procurement. So that's something, I don't know
Yeah,
if
it's on the consultancy side.
Sorry?
It's on the consultancy side.
So it's not
Yeah.
on the
Not on the
construction
contract,
side.
not as yet.
So we started to make a move in that direction. So the point here is that there's a lot of for this kind of work, there would be a lot of support also from the Caribbean's bilateral development partners. Already we have organizations, Britain, for instance, Canada, for instance, which provides a significant amount of grant financing, trust funded or otherwise. I mean, for DFID you already have to CDB, but from Canada side, for instance, I don't know if many of you are aware, some countries may be aware that after Maria and Irma, Canada brought to the table $15 million worth of, which is huge amount for trust fund for capacity and implementation support for several OECS, Eastern Caribbean plus non-island member states. So those are the kind of initiatives which are important to help in these areas. I just wanted to mention this point.
Yeah, I mean, in St. Martin, I just concluding an arbitration. This is, again, 2 years later on a hotel project. And because it's just taken that, partly insurance company, but at the same time, I was there 4 weeks ago. So many buildings still, hotels still not started back up. There's a shortage of contractors again. As I said, I lived in the BVI for 10 years. You couldn't get, well, for the first 12 months, you couldn't get contractors. And if you could get a contractor, you have to be paying a premium. You had to pay a premium, and that's the only way you could get them back in. And then, of course, they have their own local labor laws as well, which you've got to comply with. So you can't just flood the place with a workforce and things like that. So it all becomes very challenging. And of course, if we had, these disaster recovery plans and contingent plans, which involved all the stakeholders, I don't know whether they actually address that. I'm not sure. But, if you involve all the stakeholders, all these points would come up from World Bank to everybody else. All these points you're talking about, which you have experience in, are really important.
Great.
Can I suggest something practical? I don't know, as an outcome of this discussion today, I mean, because you have a lot of key players out here, your private sector plus, your government side, as well as partners, international partners. Maybe a small task force can be set up that can try to unlock this issue of capacity in the wake of natural disasters.
Yeah.
And no, I don't mean like within a month, but we are now 2 years into, 2+ years into the 2017 Atlantic season, hurricane season. And you have seen the situation on the ground, whether it's Dominica or St. Martin.
Absolutely. 50%, BVI, I would say 50% to 60% of BVI is probably reconstructed. There's still a long way to go.
Can I ask Daniel, you talked about your emergency sort of contracting for consultants. Is that a model that you could apply for in other areas, for construction, for engineering?
Yeah, I mean, I don't see any reason why it shouldn't be rolled out. Is essentially it's based on pre-qualification type structure. So we invite consultants to submit RFPs, look at the qualifications, look at the capabilities, and in the event of a disaster, we can draw on these individuals. And I think the same thing could be applied to the contractors within the region. If we're speaking quite frankly here, though, and if perhaps we're not being recorded, it depends what you're going to say. But no, but in all fairness, we all know that drawing on contractors, especially at times like these, I'm happy to present his reasons, but at times like these, we found that we found that there are linkages sometimes in countries.
Yes,
Yeah,
absolutely.
and which on occasion don't redound to the best will of the country overall, right? So we would have no issue as the Caribbean Development Bank, I imagine the World Bank, the IDB as well, to go through that pre-qualification process outside of a disaster type environment, because in the post-disaster period there's absolute chaos. Yeah, and there's absolute chaos. We have a number of products, as you know, under our disaster management strategy and operational guidelines, but just getting countries to sometimes follow this could be unreasonable. So we need to do whatever we do. I mean, the Prime Minister made the point quite well. In the period outside of the hurricane season, this is the time we need to work. So
I think you have to go beyond just pre-qualification.
And
Because as you say,
going through that pre-qualification process.
but I think I would go beyond
drawing on them.
pre-qualification. I would say you even have tender for a contingent contract. It would not be for the full thing you need because you don't know exactly what you need. But as you say, there's this chaos that occurs. So these linkages have more power in the middle of chaos.
Absolutely. And I think, to your point, once we have this list of contractors that can be drawn on at short notice to execute works, I think the development community will certainly support that.
Maybe this is something, Daniel, that we could, because this involves our procurement rules and procedures, that the two banks could, maybe IDB as well, because you may not be in the small islands, but there are other countries you're involved. No, I meant in Suriname and Guyana, the other countries where you are active, to look at the question of this, for the construction side. It's essentially when the cameras are gone, what is happening on the ground then? That's the, which is the longer term part.
Brilliant. So Sanjay, you've managed to make sure that other people have your homework.
That's good, isn't it?
But let's stop there, and let me thank you very much for a very interesting presentation. So now we're going to move to contingent credit lines and the new contingent credit facility of the IDB, and Leslie Stone. Are you going to do it from there, Leslie?
All right, good afternoon. So I think we're on hour 6 of Insurance Talk, and after a nice big lunch, I'll see if I can keep you awake for a few minutes. My name is Leslie Stone. I work at the Inter-American Development Bank. I'm here with our director, Selwyn Hart, and the IDB team. I'm very happy to be here. Thank you for the invitation from the government of Barbados. Today, I'm talking about the role of the MDBs in natural disaster risk financing. Just an interesting fact I learned at lunch. So this is Hurricane Dorian, and my understanding is that the eye of the hurricane actually passed over Barbados, which was why it wasn't affected. So I don't know if that's true or not, but that's what somebody at my table said. Anyway, I'd like to start with talking about. I'm actually going to skip the first few slides since my colleagues at the World Bank talked quite a bit about the disaster risk financing. I work in our strategic planning and development effectiveness department, and our department is tasked with designing and monitoring and supervising the lending instruments. So we have this ongoing exercise to look at different sets of lending instruments and make sure that they're still relevant, the operational guidelines are still efficient, et cetera. So after the 2017-2018 hurricane season, our President Moreno tasked our division to look specifically at the natural disaster instruments and come up with something that works, especially for the Caribbean as well as other regions. So we're an MDB. We've got a broad spectrum of instruments, both for pre-disaster risk as well as post-disaster recovery. But there's really been a shift towards moving towards these ex-ante instruments for many reasons. It's really about reducing vulnerability, building capacity, strengthening institutions, and improving information sources. So as I said, my colleague from the World Bank did quite a thorough presentation on the risk financing instruments. The IDB works in all of these areas. The insurance markets are sort of a newer area for us, but for today I'm focusing on our contingent credit instrument. My colleague from the World Bank had a similar graph, so we'll skip that. So our main instrument, our main ex-ante instrument is the contingent credit facility, which was actually established in 2009. We originally had set aside $600 million in a specific facility for this purpose. In 2012, we eliminated the facility and changed the funding source to come from the country's annual lending envelope. This instrument is for up to $300 million or 2% of GDP, whichever is less, and it's approved ex ante, which is a very important feature of this instrument. So the idea is that we provide a very significant amount of liquid resources to cover these extraordinary expenditures. So, I mean, the two key features are it's approved ex ante, it's a significant amount of resources, and we actually waive IDB procurement. So the procurement discussion we just had is very relevant for this instrument. So these are, we've got 12 operations in our region. Most of them have been approved more recently. We're working with Barbados. We just received the request from Barbados, I think in light of Hurricane Dorian, for up to $80 million. And essentially, yeah, the Caribbean, we've got actually 4 countries here. And again, in the case of Hurricane Dorian in the Bahamas, given that it was approved ex ante, the bank was able to disperse $25 million within 5 days of the disbursement request. And it anticipates dispersing the other $75 million actually very soon. So what exactly is our instrument about? It's a parametric contingent instrument that was developed with donor support, which uses parametric triggers that allow for this quick estimation of financial impact of hurricanes, floods, and earthquakes mostly, as well as dispersing quickly. So essentially, we developed this with the assistance of the leading scientific institutions, including NASA, NOAA, the USGS, and reinsurance companies. So basically, satellite information is used. Again, other colleagues have talked about the modeling. And the success of this innovation can be seen in this very quick disbursement after Hurricane Dorian. So to quote the Prime Minister, I think we probably are the largest in the Bahamas, given that I think the CRIF was a 12.8 million. Our disbursement will be 100 million. And my understanding is I think the rest will come from their fiscal balances. So essentially, we've got other forms of insurance that we're developing, index-based livestock insurance, et cetera, but our main focus right now is on the contingent credit facility. So I just wanted to highlight, actually just yesterday, our Director Hart was at the board meeting at 10 a.m. and then he hopped on a plane at midnight from New York to get here in time. Essentially, our board just approved some new and exciting improvements as well as an expansion of the CCF. So as part of this exercise to reform the instrument, we've extended the period of recognition of expenditures. So the instrument really is focused on the emergency period. But what we found in the case of Ecuador was that 180 days just wasn't enough, given the procurement issues, the contracted procurement that was happening. So we extended the recognition of expenditures another 90 days. So it's still a bit of a race against time, but we were able to extend the period, and we find this is a welcome benefit in the case of the Bahamas. The second innovation was we've been able to reprice it, so it's much more attractive to the borrowers. We used to charge a retroactive drawdown fee, so from the time that you sign the contingent line until the disbursement, we would charge a retroactive fee. But essentially, the bank's not setting aside any resources anymore for this, so we're not incurring any costs. So we were able to actually eliminate that fee, and we charge a one-day commitment fee at the time of disbursement. So in that sense, it's very attractive. The countries only pay if they use it, and in the end, it's a one-day commitment fee, which is quite low compared to other instruments. We also offer the option to replenish the funds. So for example, in the case of the Bahamas, we recently approved it, dispersed it, under the old rules, they would have had to go back through the whole loan approval process, et cetera. We've now come up with a clause to request a replenishment, so the loan is actually good for up to 10 years, and it's a much expedited procedure to request the replenishment of those funds. So essentially, Bahamas will have access at any given moment to the $100 million, for example, if they request before the next hurricane season. The other exciting innovation, you could call it, is an expansion. So we've actually created another modality within the CCF to cover non-parameterized risks. So we're recognizing that based on current technology, we can't parameterize, I don't know, we don't have good models for droughts or tsunamis, some tropical storms. So this new instrument is actually, I'll show you the comparison here. It's for up to 100 million or 1% of GDP, and essentially has the same set of triggers, except for, since there are no parameters, we're requiring, in addition to an emergency declaration, this compliance with complementary risk retention financing measures. And essentially, it's sort of an excedence loss product in a sense. It complements budgetary reserves, emergency funds, the CRIF, any other sort of risk retention financing that the government has. So this is intended to top up the government's spending on the disaster. Let's see, I'd also like to discuss the Comprehensive Disaster Risk Management Program. So in addition to the financial support the bank gives, it provides a lot of technical assistance in parallel. This is one of the conditions to disperse, is that the country has a satisfactory comprehensive disaster risk management program. So what the bank does, it sits down with the country, looks at the existing disaster risk management, and then works on these 5 pillars. And on an annual basis, the bank actually accompanies the government in sort of tracking the progress of the plan and making sure that they're in satisfactory compliance so that we can disperse in case it needs to happen. For the main CCF, the parametric triggers are based really on sort of 3 factors. It's looking at up to about severe events that happen every 5 to 35 years and affect more than 2% of the population. It's based on wind speed, precipitation, and share of population affected, and they have a much more complicated model than that, but these are the basics here. Just to answer Minister Cattle's question about what types of expenditures we cover, because in the end this is an investment loan, although we do waive bank procurement rules. So we're using country procurement for disasters. So we're covering essentially humanitarian assistance, rehabilitation of basic infrastructure, as well as no reconstruction of public infrastructure unless it's related to the exact disaster. So I think you had made the comment about hospitals. So in that case, actually, we could, if it's a public hospital, we could reconstruct if it's within the time period. As long as the procurement happens within that time period, we can contribute to that. So, and actually just sent an email to my colleague in the Bahamas to see sort of what are the types of expenditures we're financing there. And I just wanted to share his response. It's just sort of hot off the press. So for the first 25 million that we just dispersed, they're looking at things like transport costs, transport asset replacement costs, debris removal, utility restoration and rehabilitation costs, whether that's patching or temporary water mains, temporary road works, extraordinary and time-bound extension of social welfare assistance for hurricane survivors, other things like mental health assistance for first responders and beneficiaries. So these are some of the expenditures that we can cover using this instrument. Again, an important feature is how quick we can disperse. Essentially, the government requests verification. Within 5 days, the IDB produces a report, and the disbursement happens. So in the case of the Bahamas, we dispersed 5 days after that report was received. So yeah, again, like I said, we're constantly trying to improve our instruments to make sure the bank remains relevant, as well as build financial resilience in the countries and have the most effective use of the bank's resources. So with that, I'll end there and I'm happy to take any questions. Thank you.
Thank you very much, Leslie. When I saw that list of things you're doing on the ground today in Bahamas, it was a very interesting, quite comprehensive list. There didn't seem to be many sort of big expenditures, though. Is that the nature of what is going on at the moment, or it wasn't like a rebuilding of roads, or?
No, so this instrument is intended to finance the immediate response due to the emergency. So reconstruction of roads would be considered like an investment loan after this phase. So this loan really isn't intended. That's why the time limit is limited to 270 days. So really, we can only finance, in less than a year, expenditures related directly to the crisis itself. Yeah.
Thank you very much. Any other questions for Leslie? Tobias.
Well, question, does the contingent loan before its drawdown count towards the lending limit of the country?
No, it does not, and that's an interesting question, because we actually spoke with the rating agencies back in 2009 when we were developing the instrument, and because there was a concern it would affect the bank's risk ratios and capital adequacy, and so essentially it's not counted for. So, for example, the case of the Bahamas, we approved the loan a year ago. It does not go on the bank's balance sheet, and that's because the source of financing is actually from the country's envelope. So essentially, it's contingent that the country has lending space, and or they can actually, it's called an automatic redirection list. So for loans that have already been approved, we actually have a clause that you can redirect undispersed resources for this purpose if that loan is considered on the list. So the answer is no. Until a disbursement happens, it's not accounted for anywhere.
Leslie, thanks for that presentation. You're right that Barbados just requested from the bank to have access to the CCF. And it meant then that my team and I looked very closely at what the facility covers and does not cover. And a few things. I think the fact that it does count, even though it is after drawdown and not before, that it does go towards the overall lending envelope of a country, it means that you are then you're switching from development to relief. Mm-hmm. So you're choosing
Correct.
between the two, and it is something that is important for developing countries. Because it means that you don't have the option to recover as well as develop, based on the fact that you're using some of the resources from that envelope. I'm very happy, and I saw when the board started to consider some of the new modalities and the amendments, which I think really start to go towards the heart of some of these issues. Modality 2, which has to do with drought. I mean, many of you may know that Barbados is in a severe drought, one of the worst that we've seen. Issues that have to do with coastal erosion and loss, really of a big part of your tourism product, which is your coastline. I'm hoping that that's part of the category that is included there, because that's an issue for us as well. But I think that one of the other, I don't know if you are able to put back up the slide that has to do with the changes to the, I think that one of the other issues has to do with the period of recognition of expenditure. So I'm glad that it's been extended. I'm glad too that you acknowledge that even this it can be a bit of a challenge in terms of procurement, mobilizing to respond, and I wonder why it is even necessary. If we agree that there's certain types of actions that you're covering, and it's almost like a set of criteria that are kind of redundant. Because the fact is that as long as it takes you to carry out those recovery actions, they're recovery actions. So that, it's then a bit of an increased penalty on countries that can't mobilize quickly for all kinds of reasons that might themselves be linked to the fact of the disaster. Mm-hmm. And I'm encouraging you to we're glad for the changes. Progress, this is progress, but I'm encouraging us to go back to first principles, like the Prime Minister said, and look at what is the mischief that we're trying to avoid here. Because it all goes to the point of recovery. So I just wanted to make those.
No, and just on that note, I mean, I take your point, and with Director Hart, we discussed exactly that, whether 270 days is enough, because now it's looking like in the Bahamas, with the protracted procurement issues, it might not be. I guess from the bank side, there were discussions at the board, and there was a concern that this instrument be very limited to the emergency relief efforts. And so there was a concern that if we went past a year, it turns into this gray area because we're not using bank procurement, right? And the bank, you submit the receipts after, and the bank does a reconciliation. But because we're not using bank procurement, there was a concern that we were gonna open up sort of a bigger gray area in terms of what's humanitarian relief and emergency services versus what's actual reconstruction. In which case, the investment loan is a more appropriate instrument for that. I should mention, this instrument enjoys the benefit of the waiver of the IAMC requirement, which you're very familiar with. So in that regard, several of the directors were concerned that because it's fast dispersing, because we have this waiver, anyway, there were just a lot of concerns about really trying to find ways to ensure that we are really focused on the emergency efforts. But I do take your point, and I think we're constantly looking at ways to improve it. So I think after Dorian, we'll have a lot of lessons learned, and we'll see if there's more flexibility there.
And you don't need to wait just for Dorian. There's a lot of recovery still taking place after Maria and Irma.
No, absolutely. And in Ecuador, too.
2 years on.
We were only able to cover half of the relief efforts in Ecuador for that reason, because we came up on the time limit of 180 days.
Daniel and then Selwyn.
Yes, sir. I just wanted to ask what is entailed in the recognition of expenditure? Because this is the one bullet on this. Thanks for a fantastic presentation, Leslie. Sorry. But that one bullet there, I think, goes to the first one, goes to the heart of what has stymied many of the recovery efforts within the region. And because in the post-disaster period, and we suffer from it as well, so I certainly empathize. In the post-disaster period, countries struggle to pull receipts together for the reconciliation to happen. So I was just wondering, even in extending the period, what is required? And to the minister's point, and it's not just, of course, in the post-disaster period, the reconciliation effort across the board as it relates to advanced disbursements of any kind. What we've determined at CDB is that we can no longer just leave it to the countries. We can't take a hands-off approach. We've disbursed, you reconcile and come back to us. But whatever support is needed to the country for the reconciliation to happen. So actually sending officers into the country to sit and go through and support, because it's of course exacerbated in the post-disaster period because the persons who are tasked with doing the reconciliation in country, many of them, their homes are destroyed, the children can't go to school, whatever. So we have actually sent officers into the field to support efforts. So I was curious as to what triggers your recognition of expenditure, and the minister certainly threw out a point there that I don't know that we considered before, which is essentially don't worry with the recognition or the reconciliation. Yeah.
Right. So. Okay, sure.
Thanks, and let me join others in thanking you. Leslie, you are very diplomatic in terms of conveying some of the concerns of members, other members of the board who were very concerned. Some were concerned that this instrument could be, for want of a better word, misused by countries. However, our perspective was quite different, and I believe that we will learn a lot from the application of this instrument in the Bahamas. And we've really insisted that when we see how this instrument was deployed and utilized and its effectiveness in the Bahamas, we need to go back to the table as a board and see how this instrument can be better tailored to meet the needs of the most vulnerable members of the IDB family. But we push for 360 days, we push for at least a year. There is a provision that will allow us through a simplified process. We checked with the legal department, so this 270 days can be extended further through a simplified approval process through the board. But we're really hoping, Minister Turnquist, that you are frank, you and your team are frank and honest in your assessment on the effectiveness of this instrument in the Bahamas, so that those lessons can be gleaned by us at the level of the board and of course the operational staff of the bank to ensure that it meets the needs of the Caribbean. And the second point that I wanted to make related to another instrument that Leslie, or tool that Leslie did not mention, and it's that comprehensive loss and damage assessment report that IDB and Juan Carlos, you can provide some more information on it, or Leslie. We're working with UN ECLAC. A team is sent into the country to do a sector detailed analysis and prepare a report on the loss and damage in the immediate aftermath of a hurricane. And this is an extremely, and it will be an extremely valuable tool for the country and its development partners to identify the areas where interventions should be tailored for. So this is an extremely important instrument or tool that members of the IDB family can use, and the Bahamas is utilizing this tool. And again, we hope that when that final report is prepared and submitted, we can have a look to see how the IDB and other development partners can use this report to target their interventions in the Bahamas. Thank you.
Just a quick intervention by Minister Caddo. Did you want to?
I just wanted to make a just brief intervention. The contingent line has worked for us wonderfully well in terms of the expediency in which the funds are dispersed and the ease of triggering it. The only challenge that we had is exactly the one that we're talking about, this 180 days time period in order to disperse that money. Trying to spend $100 million in 3 months is a very difficult thing to do, even when you got your act together, much less in a crisis when you're trying to figure it all out. So the extension is certainly very welcomed, and is going to help us to be able to do what we need to do. The other thing that is being discussed at the moment is in respect to how or what can you spend the money on, is also an area that is a fine line, because I understand fully that you don't want this money to be used for regular infrastructure that should go under a loan or whatever. But by the same token, in our instance, we have clinics that have been flattened. We've got electricity grid that's completely destroyed. We've got water lines completely destroyed, which are, in our view, emergency issues. Fortunately, there's been flexibility in respect to that, and we've been able to classify those. But it could end up being a road, for instance. I could see where that, or a bridge, it may end up being that. And so I think maybe a little bit more conversation needs to be had about what exactly constitutes an emergency spend. But again, the experience from this will tell us exactly what ought to be the considerations in terms of reformatting the loan. In terms of the reporting, again, we don't have any issues with that. We're accounting for that separately from everything else so that we can report whatever it is that we spend it on and ensure we have the accountability that's required.
All right, and just real quick, like to answer Daniel's, his comment or concern. So we did learn from the Ecuador case not to wait a full year to account for the expenditures, because the rules say you have up to a year to provide that expenditure report, but which was why in the end we only dispersed 160 and not the full 300, because they weren't able to account for some of the funds under these expenditure rules. So in the case of the Bahamas, our procurement specialist who was the backbone of the Ecuador loan actually went to the Bahamas and is sitting with a lot of the procurement people in the country there to make sure that all the procurement documents are in order and that eligible expenditures are being met. So, but we think we're happy to be able. I mean, speaking of creative versus practical, it's both, and we're able to respond in a timely way, in a large scope. So,
and that is another important point, that the procurement process. It cannot go through the normal procurement process, and so there is an abbreviated procedure.
That's right.
That you have to come up with, and
Yeah.
We've been able to do that.
Yeah.
So.
Did you have
Thank you. Just a small consideration on the damage and loss assessment tool or methodology. I know we've been through a few tools with multilateral partners, the DALA damage and loss assessment in the context of the UN system, the PDNA methodology as well. Having been on myself, part of one of the teams that has been deployed to do this kind of very immediate assessment, the methodology is less important than the kind of statistical base that you have in the country, right? And how countries value their assets, how you understand how to measure what is lost. The methodology itself doesn't give you that. It is really what is in place at the country level that allows you to go in, get the information, and do what you need to do. So that requires then not just waiting to apply the tool, but also making sure that there's a base of information before in every country so that you can have a real understanding of what is lost. And so I would encourage that kind of investment in that knowledge, prior knowledge, be made as well.
All right,
I
thanks a lot.
sorry, I just want to make this
Quick one, yeah.
final point. And I really do empathize with Leslie and Selvin and the team at ADB. But if I were to take off my development banking hat and put on my engineer cap that I wore in a previous life, we have to be reasonable, I think, to our countries. So if the Bahamas or any country triggers this drawdown on this facility, IDB or CDB, the time it takes to assess the damage and to do designs, to do engineering designs for a bridge that would have collapsed, say, or a road that would have collapsed or whatever, to do engineering designs, as expedited as the process may be to get a contractor on board, well, first to get the consultant on board, to get the contractor on board, even if you're drawing them from a pool, for them to actually assess the damage and do the engineering designs, get people in the field to actually start to build and to get it completed within 270 days or whatever. Even if you're in the private sector, I mean, we knock our public servants quite a bit, but even if you're in the private sector where I worked previously, that is a remarkable task to
We can't even do that outside of an emergency.
Yeah, I mean, if I could just add to that, yeah, I mean, unless you waive all the tendering processes, that's the only way you do it. You appoint your engineer or whoever it is, and then you say, okay, we're going to appoint such and such a contractor, but we're going to have, this quantity survey, or whichever independent company that's going to make sure that you get value for money. Unless you do that, you're right. It's going to take you a minimum of 3 to 6 months before you get anything off the ground. Not to mention planning permission.
But I think, again, you have to bear in mind the kinds of expenditure. So we're not talking about bricks and mortar per se. And I think that's where you start to get into that gray area again.
Great. Let me thank Leslie for a great presentation, very clear, and to thank the whole team at the IDB. And I want to thank the whole team at the IDB for listening to some of these issues and listening and suggesting that they'll continue to look at it and refine the product. Thank you very much indeed. So the next session is disaster insurance or resilience insurance. So we've talked a bit about how it's increasingly hard to insure something that has had large loss and damage, 200% of GDP, that is growing in size, increasing in frequency, and increasing in correlation. And so one alternative to that is resilience. But how do we incentivize resilience? And is there a way of using insurance or other ways of incentivizing insurance versus post-disaster, incentivizing resilience as opposed to post-disaster insurance? So we have Ruben Hofflinger of Swiss Re, who's going to come and talk to us about that. Thank you very much.
Thank you very much, Mr. Chairman, for the invitation to participate in this event and be able to share with you the perspective of a reinsurance company. I will be presenting together with my colleague, Tobias Meyer. And to be honest, we have, along the day, listening to all the participants, the discussions, we have made a lot of amendments to the presentation, really trying to capture the essence of the discussions, the open questions. And to start with, Tobias will start giving a brief introduction of the topics we want to discuss and give a few examples of case studies across the world. And then I will give a deep dive on the Mexico disaster risk financing and insurance strategy, which we believe captures many of the topics that were discussed along the days. And then I will give just a brief conclusions on some of those open questions that were placed along the day.
Thank you very much indeed. Avi chose the title for our session, and so we then had to struggle to come up with something that matches that title. It's a best practice for hosting conferences, I might say. I'm going to start with this slide, which captures something that has been mentioned a number of times today, which is what we call the protection gap. What you see here are total losses at a global level from natural causes. And the gray bar portion of each bar is the uninsured loss, and the dark portion is the insured loss. And so you see that this is growing, obviously, and I added there the 2017 year, which obviously where total losses were impacted tremendously by the hurricanes and also wildfires in California. What you see in the green lines are the running 10-year averages for both the insured and uninsured losses, and you see how this is increasing. So there's a couple of takeaways. First of all, yes, 70% of total natural disaster-related losses today are not insured globally. But the thing to realize about this is that first and foremost, this trend is not driven by climate change or cannot be attributed to climate change. It is driven by the concentration of assets the ever greater concentration of assets in exposed locations, meaning that the same hurricane today has a far greater, in nominal terms, economic impact if it hits Florida, if it hits Miami, than it did 30 years ago. I would also say, by the way, in reference to the 2017 year, is that the insured proportion is quite large, and I would argue that that has to do with the fact that Harvey impacted the United States first and foremost, where the insurance penetration is higher than in a lot of the places where these events typically occur. Now, what we observe at Swiss Re, we're a global insurance player. A number of companies have made the point that they're number one. I'm going to just leave you guessing where we stand in that in our ranking. But the point is this: we are very much at the forefront of working with public sector stakeholders on insurance solutions. And what we're going to share is what we observe, how these governments go about implementing them. And the key point, I think, that I would would make is that we observe an increasing interest and application of techniques that are really bread and butter of the insurance industry, which is around identifying risk, quantifying risk, measuring it, and then thinking about the different cost-effective options that you have with dealing with it. So avoiding it in the first instance, mitigating it to some extent, adapting to it, transferring to it, that is the idea of a market-based insurance instrument, and then accepting residual risk that you are that you are comfortable with. Rather than start with the solution, a lot of times when we talk about public sector stakeholders using market-based risk financing instruments, we throw around terms, cat bonds and parametric insurance and so forth. What I'm going to try to do, and Ruben will focus on the Mexican case, on his deep dive, is not so much the product, but how do these governments embed those products in a broader policy approach and programs that are aimed at increasing their resilience and those of their constituents. First of all, this is a quick map of sovereign risk transfer schemes around the globe. You'll recognize obviously the blue circle there indicating the CRIF. I would like to point out that this is by no means an emerging markets phenomenon. The US government is arguably the largest buyer of market-based insurance and reinsurance through its National Flood Insurance Program. That is a recent phenomenon. And there are plenty of these cases that you see here that have benefited from the technical support of some of the institutions represented here, first and foremost the World Bank and the Inter-American Development Bank, and perhaps also the Caribbean Development Bank. But there are also examples of sovereigns finding their way to the market without the assistance of these of the IFIs. Notably in China, which is one of the examples that I would like to highlight, maybe one distinction that I will make before we go into it. It's hard to classify all these different schemes in neat buckets, but you can think of them in three broad and loose categories. Excuse me, we're looking at the wrong slide. How do I go back? Here. We sort of distinguish between the idea of a macro insurance cover. Never mind what the legal format of the cover is, whether it's placed in insurance or in reinsurance or in capital markets. The idea of a macro insurance is that the risk transfer solution is really designed for the sovereign or for a sub-sovereign in some cases, as we'll see, to hedge their budget against the contingent liabilities that arise implicitly or explicitly on their balance sheets due to natural phenomenon. Another slightly different approach, but where governments have a central role to play, are the design and implementation of what you might call national schemes, whereby homeowners or business owners are somehow incentivized, in some cases compelled, to work with the insurance market, and the insurance market might be given incentives or restrictions to contribute their part to making that scheme viable and to increase the insurance penetration at affordable rates, at sustainable rates. In the last case, for which I don't have an example today, but we could talk about it, is schemes that incentivize individuals, typically in emerging markets, for example, people who live from the agricultural sector, to roll out insurance products, them either subsidized or completely paid for it by somebody else, but where the beneficiary, the direct beneficiary, are individuals. So let's look at one example here. This is an example from China. Heilongjiang is the northernmost province of China, at the very northeastern tip of the country. It has the staggering population of 40 million just in that province. And it's a population of which a large part depends on the agricultural activities for its livelihood. The context here was of a provincial government that has the authority over its own budget. That is not the case in each, or obviously that is different how that is handled in each country. And you had a long history of that provincial government coming essentially to the rescue of people who are not able to cope with the impact of risks like flood, freezing temperatures that might destroy crops, excessive rain, lack of rain, and so on. And so as they embarked on this journey to better manage that cost, that contingent cost that they are confronted with, not every year, but some years, they had a long record of understanding where these thresholds are in terms of severity that lead to population needing assistance and how much cost that results in. And I put up the map in here. This is a map of Heilongjiang, the province. And you see in how it's divided into what I believe are counties. And the colored ones are those that were eventually through an analytic process and also a political decision ultimately included in this program. In other words, if you live in one of the colored counties, then you are eligible to benefit from the insurance that the government took out without your knowledge. I don't think these ultimate beneficiaries are aware of how the government manages this. But I point this out because it's important to understand that countries, or in this case sub-sovereigns, they don't just buy insurance from one day to the next. I'm sure Criff has many stories that illustrate this. They think about how do we delimit, slice and dice our risk, quantify it, and then make efficient use of the market's appetite to transfer it. I am certainly not doing justice to the work that goes into design of something like this. Heilongjiang bought its first insurance for this purpose in 2016 and have renewed ever since. But in the interest of time, I'm going to skip to another part of the world that has a completely different approach and a different problem. This is the United Kingdom's Flood Re project. As perhaps to demystify that point, all companies and initiatives that are called something Re are reinsurance projects, like Swiss Re. They named their project Flood Re because they essentially created a publicly owned, mandated, single-purpose reinsurance vehicle that accepts flood risk from the private insurers who distribute it, who sell it to homeowners and businesses. So the context here in the UK was one of a recognition that increasingly homeowners and businesses who are believed to live in flood-prone areas were finding it impossible to obtain insurance at the right prices. And so the government intervention here, and this is something that, again, I summarize in a couple of words, but this is really years of sort of building political consensus and then implementing it, was one of creating this vehicle, Flood Re, which is an entity that reports to Parliament, which was capitalized by a levy imposed on insurance companies in the UK that raised capital of something like £2 billion, I believe, which is calibrated to withstand the capacity of a 1 in 200 year event. What does that tell us? It tells us that there were studies conducted in the UK to understand the relationship between the severity of flood and the probability of their occurrence. And so if we say this was designed to withstand a 200-year flood, it means that in the annual probability of this flood that this is believed to be able to pay out is 1 in 200 every year. But it is possible that you have a greater flood, and this vehicle will not be able to absorb it, and that is the residual risk that still remains on the shoulders of, well, private citizens, but also on the government to the extent that it feels compelled to intervene in such a situation. So again, it's an example of sort of thinking through quantifying risk and then deciding what is the appropriate risk to insure and how do we deal with the remainder of the risk. Two very key things to know about Flood Re. The way it operates is that it reinsures risks that primary insurers sell to homeowners for flood, but it only does so at premium levels that are based on the ultimate insured's tax bracket and not on their exposure. So that means if I'm a primary insurer in the UK and I'm competing over homeowner insurance with everyone else in the market, then I will be incentivized to bundle flood, to offer flood as an extension to that homeowner's policy, but to only charge as much as I'm guaranteed to get back when I cede that risk to Flood Re, which again is based on the insured's tax bracket and not their exposure. I think it's a tremendously innovative approach, and obviously Flood Re, by the way, just to augment the confusion, then cedes most of that risk that they accumulate on their balance sheet to international reinsurance, which in an act that is called sort of reinsurance of reinsurance, which is called retrocession. But it shows that the risk is collected through individual policies, is aggregated at the level of this special purpose vehicle, and then atomized in the parlance in the international market. The second thing that's really important to know about Flood Re is that it only applies to properties that were constructed before 2009. Now, you can be sure that that is a bone of contention when you're a homeowner who built their house in 2010. But the point here is to fix a cutoff line, in this case retroactively, and say, you know what, if today you're still building your property in a flood-prone area, then it's really your own responsibility. Because there are maps in the UK that tell you where you will be flooded, and so don't build your house there in the first place. At the same time, obviously, you have a ton of historic property that was constructed previously, and so you cannot make this transition from one day to the next. With that, I'm going to hand over to Rubem, who has the benefit of having led Mexico's disaster risk fund and the evolution of their system, which is believed to be sort of state of the art. And he's going to talk about it, what it all amounts to. Thank you very much.
So, looking at some of the, or most of the comments and discussions, I felt it was a good example to talk about what Mexico has done over the years. And I'll start with showing how the Natural Disasters Fund in Mexico was when it was created. It's called Fonden. I will use the term Fonden for short purposes. So it was created in 1996, and it was, at the beginning, was really just a budgetary program within the federal budget of each year. If there was a natural disaster, the ministries will claim from the Ministry of Finance resources to reconstruct the roads, schools, hospitals, and so on. There were no rules. There were no disaster declarations or emergency declarations. There was no involvement of the local governments. It was simply a budgetary tool. Over the years, it has come to evolve to what we see in this slide. I'm not planning to explain each and every detail to you, but it's just to show how an important evolution can come up. I will show just some relevant things that happen over the years. For example, the federal budget law was amended back in 2006, and it make it mandatory that no less than 0.4% of the federal budget of each year should be allocated to this Natural Disasters Fund. So with that change in the law, the government has now certainty of how much resources they have on their own self-retention fund, which is around, right now in dollars, it's around $1 billion. So at the beginning of each year, the Natural Disasters Fund can count on at least $1 billion of resources to attend natural disasters. Another relevant topic was the same budgetary law has a mandate of, if for any reason there is a year, what we call peak years, where you have a lot of disasters or one major disaster and the funds are exhausted, exhausted, you can use oil surplus revenues to pay for the additional resources needed. Meaning, the current law mandates a lot of, it has a lot of priorities set already for oil surpluses, meaning for schools, hospitals, social development programs, infrastructure for local states. But when there's a major disaster or there's a need for the fund to deploy resources, the Natural Disasters Fund comes at top priority. Before any of the other priorities, you need to have resources to attend the emergency relief, the early recovery, and the reconstruction. And also, back in 2006, the Mexican government started buying risk transfer solutions. Knowing how much money do you have on a yearly basis on your fund, you can start leveraging that fund with risk transfer solutions. Mexico started back in 2006 with a catastrophe bond, a CAT bond, what it's called. Started with an earthquake solution, parametric earthquake solution. Then that CAT bond 3 years later evolved to be not only earthquake but also hurricanes. The covered areas increased. The thresholds, the trigger, the product itself evolved to a much more, let's say, detailed and complex product, which now covers the entire Pacific region, the entire Gulf of Mexico, and the Riviera Maya Peninsula, which are all the areas that are impacted by hurricanes, and also all the earthquake-prone areas are also covered by this earthquake cat bond. And then back in 2011, Mexico decided to also buy indemnity excess of loss reinsurance coverage, meaning not only cat bonds for earthquake and hurricanes for determined thresholds, but also an indemnity cover, meaning if the losses for the fund then are above X amount, then the reinsurance cover will trigger, and then the international markets will pay for that excess of losses. It's an indemnity basis, meaning you need to go to the contrary of the parametric, where you only need the magnitude or the depth of the earthquake or the wind speed of the hurricanes to trigger a payout. In this case, indemnity, you need to go and make the loss adjustment in each of the roads, schools, hospitals, houses. So I forgot to mention that Fondent covers all the public infrastructure of the country, and also the only private sector covered is low-income population, houses of low-income population. Why low-income population? Because it's that population that doesn't have resources to buy insurance. If you are not within this layer, this segment of the population, you are not entitled to have benefit from the government. This evolution also, as you can see in this slide, there's also a preventive fund, which means ex-ante resources are allocated to do all the disaster risk reduction measures, preventive measures, mitigation efforts, in order to try to make the country more risk resilient. So this Fondent risk reduction measures, we can say that there are three main buckets where the Fondent risk reduction measures are composed. One, it's the improvement and betterment. Since 2002, the Fondent rules of operation have focused on what was discussed here previously on building back better. This is one of the major key components of Fondent rules, meaning after a disaster occurs, we need to focus on building back better. And this is what is called improvement and betterments, meaning if there is a local community that was impacted by a natural disaster, let's assume a flood event, and it's considered that the area where this community is a high-risk zone, you cannot reconstruct the houses in the same area. You need to move it to a safer area. So you relocate the entire community to a safe area. Same with schools, same with hospitals. You need a technical opinion from a legal entity, but once that opinion is that it's a high-risk zone, you cannot use Fondent resources to build on the same place that is a high risk. Same thing happens with improvements like you have a bridge, the bridge collapsed due to a river, a major flood. If the bridge needs to be wider, the foundations needs to be deeper, and you need to invest resources to make it more resilient, Fondent will pay for those resources to make it safer, to make it more resilient. The disaster risk financing strategy to support Mexican states, it's really about Fondent pays 50% of the local public infrastructure, and the states needs to pay the other 50%. Knowing that many times states don't have, when there's a major disaster, the states doesn't have the capacity to pay their 50%, what the federal government is helping them to have the adequate information, data, risk analysis, the modeling, in order to be able to also buy risk transfer solutions for their portion of the Fondent that they need to pay. This means instead of buying 100% risk transfer solution, you can buy only a 50% of the values that are exposed, because if you have insurance, Fondent will always pay the other 50%. If you don't have insurance as a local state, Fondent will pay 50% of the damages the first time you have an event. You need to commit as a governor that you will insure the public assets. If you don't do it, the next event, Fondent will only pay 25% of the losses, and in the third event, Fondent will not provide any resources. So this is a way to incentivize and states to buy also risk transfer solutions. But to buy risk transfer solutions, they need to develop an adequate database of the assets, where they are located, what are the total value of the asset, the geocoded location, and also to determine what are the best type of risk transfer solutions you need to buy. And finally, as I mentioned, Fonden has different risk transfer solutions in place. They currently have $370 million in cat bond placements, $110 million for hurricane, and $260 million for earthquake. And there is approximately $265 million on this indemnity coverage placement. And states, we can say that there's a lot of work to do. There's only like 10 out of the 32 Mexican states that currently has insurance, proper insurance covered in place. This is just to show what I just mentioned, how this Fonden indemnity coverage operates. As you can see in these bars, Fonden covers 100% of the public federal infrastructure and 50% of the local infrastructure. And Fonden has, as I mentioned already, cat bonds in place and the excess of loss coverage to finance their responsibility, and the states it's mandatory for them to buy insurance to cover their participation in Fonden. How was it possible? I think also was discussed here about the importance of having adequate information. Fonden back in 2008 started a very ambitious program to create a known model, a known risk model. The information was gathered by the different ministries, schools, hospitals, roads, bridges, housing of low-income population, coming to the fact of understanding where are our schools, our hospitals, the roads, what type of materials they are constructed, which years, how many school rooms we have, how many beds in a hospital, everything. All the information is included in this modeling. Was a huge effort of gathering information across the country to understand the total of assets that are part of Fonden portfolio, their values, their geocoded location, the type of materials, the construction, the year, the historical losses from those assets. And then with all of that information in this model, Fonden started doing what we call the risk modeling, which is running all types of scenarios of hurricanes, flood, earthquakes, excessive rain. And with that, you come to what we called unexpected loss, meaning you know what are the probability of having a major loss to your portfolio. And with that, the placement of the Fonden excess of loss coverage in the reinsurance market and the cat bonds was much easier to implement and to do. Having adequate information, I think someone mentioned here that models are good as the data you have in those models. If you don't have good data, doesn't matter how sophisticated the model is, it will be no good to make a risk transfer solution, because the international reinsurers needs to make a lot of assumptions. If you have gaps of data, it means that we need to make assumptions, and assumptions are expensive. So just quickly, I don't know how much time do I have, but I think I'm almost due. I have just two case studies that I want to show. One is, the Mexico City property tax cover for homeowners. Mexico City, after the 2017 earthquake, decided that they wanted to implement something to really expand the coverage for homeowners. So right now in Mexico, as you can see here, property tax collection is around 60%, meaning 40% of the population doesn't pay property tax. The house insurance penetration is around 27%. According to Mexico rules, if you pay your property tax in time, meaning within the 3 first months of the year, you get a discount. So what Mexico City did was, we need to do a win-win situation. I need a way to incentivize the population to pay taxes, which is by law, it's mandatory by law. But I need to make a way to incentivize them to pay, so I can have an increase on the tax revenues. And with that increase, I can pay for an insurance coverage for all homeowners, meaning the massive communication effort was, just because you pay your taxes on time, I will provide you with an insurance coverage. Why is a win-win situation? Because you increase the property tax revenues, you increase the insurance penetration, and you transfer a big portion of that risk to the international market. So when there's a major event, who is going to pay the bulk of the losses are the insurers, reinsurance, and not, once again, the government behind the population that didn't have proper insurance in place. And finally, the last one that I wanted to mention is this hurricane coral reef cover. I don't know if you have heard. This is the first, and it's a unique solution that was developed this year, together with the Nature Conservancy, which is an NGO focused on environment and coastal areas, and they were keen to develop something to protect the reef, the Mesoamerican reef in the coast of the state of Quintana Roo. Why? Because if the reef is healthy, the reef is grown. If the reef is grown, all the hurricanes and the storm surge that comes with them, the reef will protect the beaches. If the beach is healthy, we'll have tourism. If there's no beaches, there are no tourism, there's no revenues, so people won't have income, and the government won't have an income. So this was developed through the creation of a comprehensive disaster risk strategy. It was not only insurance. So the state government, together with the private sector, mainly the Hotels Association and the 6 municipalities, they developed this trust fund, which has mainly 3 components. The first one is to have resources to attend the reef and the beaches, mainly to make sure that the beaches and the reef are healthy, to maintain, to protect and reserve, and protect and restore, and, for example, avoiding overexploitation with tourist, in the tourist areas where the reef is being exhibited, avoiding pollution of the ocean, pollution of the beaches. The second component is that this trust fund will pay for the more frequent events but less severe hurricane events. Why? Because if you want to transfer that to the reinsurance market, it will be extremely costly. So this trust fund also has resources to pay for those more frequent, less severe events. And then the third component is really buying an insurance parametric solution in order to pay for those hurricanes category 4 and 5, which are the ones that are going to really impact and severely damage the reef and the beaches. And the reason it's a parametric coverage because as it was discussed here and Isaac mentioned very well, the immediate relief of resources, because what they need once the hurricane impacts the reef is to have the entire brigades to go and attend the reef. They need to go, collect the coral pieces, take them to nursery, and then replant it back. If that is not done within the first days, the coral reef will die, meaning that they will diminish in size, and it will take many, many years for the reef to grow again. So this comprehensive strategy means that the entire population of the region are already trained, the local community is trained, and they know what they need to do in order to go out there and help to attend the reef and restore it after the emergency. That's why the payout is immediately, so you can have resources to pay for this population helping with the reef. And with this, we finish with the presentation. I just want to quickly mention a few conclusions here, the things that we have heard during today's discussions. Is insurance still affordable? I would say definitely yes, but once again we need to look at, there's no one size fits all. I think Isaac mentioned very well, and other colleagues, there is not one single solution. Insurance is not everything, it's a portion of it. You need really to have a comprehensive strategy around it. There is the need sometimes to increase self-retention funds. Look at Mexico example. Mexico has $1 billion self-retention, and they are buying around $635 million of risk transfer solutions. You need also to have contingency lines, like Tobias mentioned. You also need to provide incentives to the population so they can also go out and buy insurance coverage. It's not only the government that has the responsibility. Everyone needs to have a play on it. Reinsurance prices are globally driven. I think this is very important just to conclude. Our opinion as a global reinsurer is not that the prices have gone up to the roof, is because the reality is that before 2017 and 18, since 2011, that was the last real catastrophic year with Thailand floods and what happened in Japan and also in New Zealand. If you look at reinsurance price or premiums, overall reinsurance premiums, we had year after year of discount over a discount over a discount. So the rates were going down significantly. So what is happening right now is that everyone realized that I was charging less than I was supposed to charge, and now I'm trying to go back to the prices. But if you look at prices right now, they're still below 2011 prices. So this is important to understand. We were paying less than was needed to maintain the stability of the market, and that's why after major events, the market realizes that we need to go back to a price that is sustainable. And I think with that, I will stop here and we'll be open the floor for questions if there's any questions. Thank you.
Thank you very much, Ruben. Any questions for Swiss Re?
Yeah, definitely. I think many of the topics were already discussed. I think what CRIF is doing right now, that they are expanding not only to property damage, but drought and fisheries and other lines of business is important, because when we look at the protection gap, we see this massive protection gap, but it's everything. It's not only property damage, it's everything. It's even non-damage business interruption, meaning those the population that perhaps didn't have any physical damage, but since there was no tourism anymore for a few weeks or even months, they don't have income, and that is already accounted for. Definitely, I would believe that countries should try to budget more resources to buy more limits. I would say, once again, what I said about Mexico, perhaps you need to increase the attachment point and buy more limits, or in some cases you need to decrease a bit the attachment points and buy less limit. But this is something that needs to be done on a case-by-case analysis. Definitely the CRIF won't solve everything. Definitely countries need to take into account other types of solutions, like having retention funds, contingency lines, and of course investing in building back better. I have a specific case that I forgot to mention. State of Tabasco in Mexico was impacted in 2007 by major floods. 70% of the state was underwater. The government spent a lot of money to build back better, to do all the disaster risk reduction measures needed. There's even a World Bank report on that case. Then in 2010, we had more rain, much more rain than in 2007, and the losses were 80% less. Why? Because all the retrofitting, all the relocation of high-risk zones, all the works done on dredging the rivers were properly done, and this is something that the reinsurance market would take into account. Yeah, so definitely what after TNC did a study about how the Mesoamerican reef was, they realized that over the years the reef was decreasing the size significantly, meaning this natural barrier you used to have 30 years ago, it's like a meter shorter than it was before. And this is because of many cases. Once again, it's because of pollution, overexploitation of the natural resources, but also several hurricanes have impacted the reef, and this is something that it takes years to recover. So the way this is funded, so the government already has a tax that is called Zofemat. It's a tax that is collected by, is a federal tax that is collected by the municipalities and is for the use of the federal areas, meaning the beaches and all the hotels and the restaurants and all the tourist activities that are done in the beaches. They have to pay for this tax, and a portion of that tax is now transferred to this new trust fund, meaning there is a well-defined source of income for this new trust fund. And with that defined income, you can now have the three components: constant maintenance of the reef and the beaches, avoiding, making campaigns and avoiding pollution, avoiding overexploitation, etc., to make the actions needed when there is less severe events, more frequent events, and to buy this insurance coverage. TNC, together with the Ministry of Environment experts in Mexico, did a research about how the reef has been impacted over the years by hurricanes, and they determined that only hurricanes 4 and 5 are the ones that really makes a significant impact on the reef, where you really need people to go out there and help to restore the reef and take it, the coral pieces to nursery and so on. So the coverage is only triggered if there is a hurricane 4 or 5. And if you look at it, it's a good way of expanding premium budget, because if you buy insurance coverage since Hurricane 2 or 3, it's going to be much more expensive. So with that, they decided to buy that insurance coverage. And also the limit, they did a research of what are the costs to restore after a Hurricane 4 and 5, and that's how they decided also the limit to buy. Can you repeat that, Rashmin? Yeah, that's a good point. I mean, every country is different. Of course, if you look at countries with no Nat Cat exposure, the difference is much lower. If you look at countries with Nat Cat exposure, the variance is extremely high. But according to what we have, and I didn't bring any information because, as I mentioned, we were preparing the presentation as the discussion went. We believe that the prices we will see for the January renewals, at least in Latin America and the Caribbean, will perhaps be around what we used to see in 2012, 2013. On a roughly basis. I mean, of course, you cannot say there is one account that perhaps someone is saying, why are you increasing my price if I haven't been impacted? Global reinsurance is not focused on a single risk, it's not focused on a single country. It's really global driven, the prices. But on average, we believe that the prices will be taking into account, of course, inflation and adjusted premium amounts.
Thank you, Abby. Whoops, I'm sorry. Prime Minister, ministers, ambassadors, ladies and gentlemen, good afternoon. I think the timing of me being asked to make some remarks on natural disaster clauses is quite apt because, as you may have heard already, at least some of you may have, earlier this morning, the government of Barbados launched its long-awaited exchange offer for its external commercial debt, which covers approximately $700 million face value of external commercial debt, plus about another $100 million in accrued interest, roughly 16% of GDP combined. The exchange offer was launched following probably 18 months worth of intense negotiations with the creditor committee, representing roughly 50% of the bonds. And we expect a supportive statement from the creditor committee to come out later today at some point. The exchange offer will expire later this month, with the closing expected sometime in the middle of December. And the key terms of the exchange offer include an automatic and immediate write-down of around $212 million US dollars coming off the principal and also the accrued interest bill, a repayment of the remainder over 10 years, and an interest rate of 6.5%. But perhaps one of the most novel or specific features of the transaction is the fact that the new bonds will also include what has come to be known as a natural disaster clause or a hurricane clause. The interesting thing about these clauses is that they provide essentially, in very simple terms, breathing space for any sovereign debtor that is struck by specific climatic disasters. And essentially they allow for scarce resources to be diverted to relief and reconstruction without entering into default. The clauses were first used by Grenada in 2015 when it restructured its own debts. First of all, they appeared in a bilateral restructuring agreement between Grenada and the government of Taiwan, and subsequently they were used in the exchange offer for its external commercial debt. In very simple terms, the workings of the Barbados clause, it works as follows. There are three risks that are covered by the clause: hurricane risk, earthquake risk, and ultimately also excess rainfall risk. They are very much linked to payouts by CRIF, and certainly when we were designing the Grenada clause, the first question that we had to ask ourselves together with creditors was, what is the right trigger to use in order to activate the clause? And all sorts of ideas were put forward, ranging from the path of hurricanes, the strength of hurricanes, assessments by the IMF as to damage assessments. All of those proved impractical, often because of time, because you may well have a sovereign debtor facing large payments on his public debt within days of being hit by a natural disaster. So there's obviously a need to have something that could be observed and assessed very, very quickly and activated very quickly. And certainly in the case of the Caribbean, CRIF appeared to be the obvious mechanism to use. Certainly CRIF, within, if I'm not mistaken, usually within a week of an event occurring, will issue a press release stating that it's assessed the event and will be making a payout or not, and payout follows pretty shortly after that. So it's agreed in the case of Grenada to use CRIF as a trigger, and certainly that's been used and refined in the case of Barbados. So as I mentioned before, three risks are covered: hurricane risk, earthquake risk, and excess rainfall. Once CRIF makes a payout under the policies, the government will have the ability to trigger the clause in its new bonds to be issued once the exchange offer closes. And that triggering of the clause will give Barbados an automatic 2-year breathing space, if you like, grace period on both principal and interest, where it doesn't have to make any payments on the affected debt. Interest will be capitalized, and the principal that is deferred will be added to the end, to the back end of the bond. So potentially providing pretty significant levels of cash relief over and above what is already being achieved through the simple debt restructuring. Now, the Barbados external natural disaster clause does have a special feature which wasn't present in the Grenada one, or indeed in the domestic debt natural disaster clause that was put into place in the domestic exchange offer that closed in October last year, and that is that creditors will have a power of veto over the activation of the clause. Essentially, holders of 50% of the bonds will be able to block the activation of the clause should they so wish. And this was ultimately a price that the government had to pay in order to ensure that the clause was included by the creditors. It probably was one of the toughest parts of the negotiations. But I think the government felt comfortable making that concession for the simple reason that whenever the clause is activated, it will have to make it very clear to the creditors the circumstances surrounding the activation. And I think our sense is that in practice, there'll be very little incentive for creditors to actually try and block the activation of the clause, because obviously the consequences could actually be probably worse for them should the country not be given that debt relief which it's entitled to, and which it presumably will need at that particular point in time. So in terms of what are the benefits of natural disaster clauses, well, obviously for the sovereign debtor, they're pretty clear and pretty obvious. It provides immediate breathing space and a buffer to help it in probably one of its most vulnerable and fragile times. But there are also clear benefits for creditors, because what we expect to happen is that they will reduce the instances where a sovereign debtor is forced into default as a result of an exogenous shock in the form of a climatic event. It is far better for creditors to have in place a built-in mechanism for deferring payments, for extending repayment periods without actually causing a credit event. It's very important to understand that if the natural disaster clause is triggered, it does not constitute a credit event. It will not lead to a credit rating downgrade, for example, because it's all been done within the realms of what is permitted by the documentation for the actual instrument. For now, I think it's fair to say that in context of negotiations, and obviously we're still very much in the infancy stage of these features, in a restructuring context, NDCs are still being seen as a concession, if you like, that is being made by creditors to the debtor. But I think that's probably going to be changing as we go along and as these clauses become more and more common. And really as both creditors and debtors thinking on how to deal with increasing and evolving risks actually advances, that's certainly what our expectation would be. I think there are probably two frontiers now that will have to be crossed in the development of NDCs. I think the first one obviously is for NDCs to appear in primary market issuances. And secondly, it is for these clauses to be used in loan contracts being extended by the official sector, whether it be multilaterals or official bilateral creditors. On the first of these points, we know that the IMF has already been encouraging some of the more frequent issuers that are also prone to exogenous climatic shocks to consider including such clauses in their primary market issuances. As you might expect, there is initially some reluctance, some concern. And what do these concerns evolve around? What usually tends to be concern around pricing implications, access to finance, credit rating implications. And I do find it curious that quite often, people ask us, what are the credit risk implications? But we keep on saying, if anything, it's actually credit supportive, because again, it reduces the likelihood that there will be a messy and chaotic default in the event of an exogenous shock. And I think that message is now becoming more and more accepted. Obviously, we still have a kind of a first mover problem. That always tends to be the case with these sorts of innovations. And I think there are probably parallels to be drawn with the introduction of collective action clauses into New York law governed bonds back in 2003. There were quite a few years of academic discussion around these things prior to that. A lot of concerns amongst emerging market issuers about whether the market would demand higher pricing in exchange for agreeing to documents including these bonds. But lo and behold, it didn't happen. And it was in 2003 that Mexico took the plunge with some persuasion from the US Treasury and managed to have pretty much the same market access that it had before. And with a very short period of time, Brazil and Uruguay had done the same. And now the inclusion of collective action clauses in emerging market bonds under New York law is very much a standard. So we do feel that this will be the case eventually with adverse weather clauses or natural disaster clauses, specifically in the case of countries where, which we know are becoming increasingly prone to climatic risk and climatic disaster. If people say, well, we just don't know how to price these things, well, they probably aren't pricing existing risk as it is. And we know that the markets are full of smart folk, and we have no doubt that they will eventually figure out how best to price these things. Now, in the case of the official sector, I mentioned before that in the case of Grenada, it was actually Taiwan that was the first creditor to agree to adverse weather clauses, but we do feel that now is a time for the broader official sector, particularly the multilaterals, to take a leading role in this. And I think to some extent there'll be a virtuous circle created if this happens. I think the private sector, the markets, will be more encouraged to adopt these clauses if they see that the official sector is doing the same, because I think we have to recognize the fact that certainly in some of the smaller, more vulnerable countries, official sector debt often represents the bulk of the public debt outstanding. So obviously having the external commercial debt, or domestic commercial debt for that matter, including NDCs, is only going to be a limited effect if the official bilateral debt or the multilateral debt doesn't have the same features. Obviously, there's an element of bureaucratic inertia involved and simply fear of making changes, but we do feel that it is important to really head increasingly in that direction. And I think this also ties in quite nicely with, I think, what a growing interest in, I think, what we call counter-cyclical financing. Because I think if we take a step back, that really is what NDCs are. They're a counter-cyclical feature, and they don't have to be linked solely to natural disasters. They can be linked to any exogenous shock that affects a particular country, whether it be droughts, oil price shocks, you name it. I think ultimately this is about recognizing that the costs, the dislocation caused by sovereign debt distress can be quite considerable, not just for debtors, but for creditors and also for the system more generally. And anything that can be done to ensure that debt instruments are able to track to some extent or adapt to a country's evolving payment capacity, that can only be a good thing, which is why we now hear increasingly about GDP-linked bonds, for example. I think the French aid agency, AFD, has been experimenting with counter-cyclical loans in the case of some African countries that are highly exposed to changes in world prices of certain commodities. So I think it's more, there's a greater need to continue to evolve and refine these sorts of instruments, because that can only create more resilience, I think, in the system generally. And I think also it will involve adaptation and evolution within the creditor community, because ultimately, whenever you have a debt instrument that has a set of cash flows attached to it, which can change over time and can become variable, you start moving away from sort of, say, fixed income, and you start looking at almost at more of an equity-like structure. But I think that probably just reflects, the evolving types of risks that I think we're all facing in an increasingly uncertain world. I think I'll stop there, and I'll be happy to answer any questions. Well, I think they could be huge on the. I mean, what I should have also wanted to mention is that once the external exchange offer closes, assuming everything goes to plan, Barbados will have probably about 80% of its public debt, external and domestic, subject to natural disaster clauses. That is huge. So essentially, Barbados will become the first country really on earth that have the bulk of its public debt stock essentially climate resilient. I think obviously. We're talking about $400 million per year for 2 years, combining the domestic and external US, at the height when the amortizations begin. I'll take your question, first question initially. I think in terms of just understanding how the savings, where they come from, so in the case of the new bond that will be issued, if at any point the clause is triggered by the government and is not blocked by creditors, the principal and interest falling due during the subsequent 2-year period will not be paid. They will essentially be deferred. So the principal will be pushed out, stuck at the end of the bond. So the bond essentially will increase in terms of duration, and the interest will be capitalized. So all the principal interest that would have been paid during that 2-year period will be converted into cash flow savings. So I think given the magnitude of the debt that is covered by NDCs, that will be covered by NDCs in the case of Barbados, once external debt is exchange offer is concluded, the savings potentially are massive. So that's where the savings are coming from. And I think in terms of pricing, look, I think ultimately something that will be borne out by the experience. But I think certainly the capital market bankers that we've spoken to about these things take the view that it will not be difficult for a sovereign issue to make the case to its investors that this is actually, as Avi mentioned earlier on, is actually reducing the risk of default. And I think everybody in the market knows that when a default occurs, it usually translates into a much bigger cost for investors than otherwise would have been the case. So this is trying to contain the situation. Because we all know if a hurricane strikes, it strikes, and the outcomes are uncertain. This is really trying to put bookends on it. So we're fairly convinced that it's really not going to translate into anything significant in terms of pricing. And I think for the region, because obviously most countries do have fairly active domestic capital markets, I think the low-lying fruit is your own domestic issuance. And I think people who invest and live in your own jurisdictions have a lot to gain for ensuring that the country itself retains as much foreign exchange during a time of crisis. So I think that's obviously the place to start, is by inserting NDCs into your own domestic instruments. And I think, if I'm not mistaken, the government of Barbados has already made the commitment that once it starts issuing fresh bonds, again, as part of the current program, it will include them in its primary market issuances. So I think there's some that will be borne out by experience, but we do feel that ultimately it's going to certainly be price negative. It could actually be price supportive in due course. Certainly the rating agencies take the view that we expect them to take as to the implication, the significance of these clauses.
Please join me in thanking Sebastian. I was reminded by Benoit Pierre at lunchtime when he said, there are things you just have to go and do it. Just do it. Well, we've just done it. Justin. Can I invite you to come and talk to us about resilience bonds?
For a moment there, I thought I had switched companies. But pleasant good afternoon, everyone, Prime Minister, Minister, and their colleagues. I know I'm one of the last presenters here before the panel discussion, so I'll try to keep it brief. I think the agenda has been so well curated that I'm coming here to speak with you about building ex-ante resilience through an approach which we consider to be a true pre-resilience bond. By now, any of you who have seen my presentations previously, you know that this is my ground zero slide. And it's the one that I remind all of my staff every day to take a look at. It's the one that really keeps us doing the job that we are meant to be doing, and why we do the job for the Caribbean Development Bank and for our ultimate stakeholders. It shows us that our per capita GDP for maybe the last 2 decades was above the global average, but something happened around 2016, and for us in the Caribbean, our average per capita GDP has fallen below the global average. When we do projections, as the Prime Minister mentioned, it means that by 2050, the Caribbean is likely to be one of the poorest regions in the world. And so, folks, I think this is really the wake-up call for us. And when we look at some of the reasons why we're falling behind, one of them really has to do with the huge vulnerabilities that we experience in the Caribbean. So my presentation, I'm just going to give you a little bit of a brief development context for the Caribbean. Then I'm going to go through with you a recent publication that we've done on how we measure multidimensional vulnerability in the Caribbean, and then to speak with you ultimately about why I'm here this afternoon, about a pre-resilience bond. So this particular slide just really summarizes the main challenges that we're experiencing here in the Caribbean, and we have tried to categorize them under macroeconomic, productivity and competitiveness, human development, and environmental. And then we think that in the Caribbean there are already some cross-cutting challenges that we're experiencing. And this is related to a huge implementation gap that we have, and we have a regional approach gap. Again, anyone who was at the discussion last night would understand that many things we can do a lot better in the Caribbean if we were simply to come together and do it at the regional level. So this is just a snapshot of what's going on in the Caribbean, and this is the estimated 2018 GDP growth rates for selected borrowing member countries of the Caribbean. Don't really look at the actual countries, but what's really worrying for us is that on average, our countries are only growing by about 2% per annum. And this is expected to continue again in 2019. Oops. Along with our dismal growth rates, we have had instances in the Caribbean where our debt to GDP ratios have been too high. Some of our countries recently have taken corrective measures, and I should say we're here in Barbados, and Barbados is actually doing the right thing. Before the current government came into power, the debt to GDP ratio was almost 160%. By the end of 2018, less than a year in office, that had come down significantly. Now, we have seen other types of structural adjustments in the Caribbean. So, for example, Jamaica has now done particularly well. In 2012, the debt to GDP ratio in Jamaica was about 146%, and now it's also come down significantly. I think what these two countries show us is that with the support of the international community and doing the right things, you can actually now get your debt to GDP ratios down to sustainable levels. But probably we don't want to get there in the first place. But this is actually causing us a significant amount of vulnerability in the region. Now, I don't have to say too much about this. We know that we are also vulnerable as it relates to natural disasters. For our borrowing member countries, we've estimated that losses over the last few years have been in excess of about US $27 billion. Now, Minister, I know that you're here, but we've done some estimates of what we think Dorian has cost you, and we're estimating that it's around 50 to 80%. These were just some of the estimates that we've done, and we're still waiting for the official statistics on this. But when you look at some of the data, for example, Dominica, imagine Dominica in 2015 lost 90% of its GDP due to Storm Erika, and then less than 2 years later lost in excess of 200% of GDP. How do our countries recover from this? And this is what I'm going to be speaking with you about shortly. So it's quite evident that many of our countries are vulnerable. And so we've been hearing about this for some time, but how do you actually measure the vulnerability? We know that we're vulnerable as it relates to environmental considerations, but at the Caribbean Development Bank recently, we decided to come up with a new multidimensional vulnerability index, which measures vulnerability as it relates to economic vulnerabilities, social vulnerabilities, and environmental vulnerabilities. We've actually managed to collate a lot of data to allow us to calculate that. And the next couple of slides, I'm just going to give you a brief snapshot as to what those vulnerabilities are for each of our countries. Now, when we did the assessment, surprise, surprise, Haiti came out as the most vulnerable country within our membership. This is across social, environmental, and economic. Now, we've been having discussions internally within the bank around this. With a country being so vulnerable, it will require massive interventions. And in fact, every 4 years at the Caribbean Development Bank, we replenish our special development resources. And every 4 years, we allocate about $45 million to $50 million in grant resources for Haiti. That's a drop in the bucket. What Haiti requires is a massive intervention. But when we look at all of the other countries, many of our countries are also similarly highly vulnerable. Now, the good thing about this assessment that we've done is that it will allow our countries to prioritize which vulnerabilities they want to tackle in order to build resilience. So take, for example, a country like St. Lucia. When you look at the vulnerability scores here, this is the total vulnerability score. But you're able to actually drill down to see where is St. Lucia actually vulnerable? Where would you get your biggest bang for your buck if you have to prioritize your expenditure? And for St. Lucia, that actually would be on social vulnerabilities. And for some of the other countries, we're able to say, okay, for Trinidad, you need to tackle your economic vulnerabilities. Similarly here in Barbados, it should be your economic vulnerabilities as well. In other countries like Dominica, it would be on environmental vulnerabilities. So for example, this just gives you a map of the individual vulnerability scores as it relates to the sub-indices. And here, this is the map as it relates to economic vulnerability. And that just shows you the coloring. And you can see that Haiti, of course, is highly vulnerable with respect to economics as well. Here, we go into the social vulnerabilities, where we have estimated the vulnerabilities as it relates to crime, unemployment, and poverty. And that just shows you which countries are most vulnerable as it relates to the social vulnerabilities. And then, of course, we then did an assessment of the environmental vulnerabilities. Now, what we did was we pulled all of this data together to get an assessment of the multidimensional vulnerability of our countries. But the beauty of this exercise is that you're able to look at each of the subcomponents of vulnerability and determine where you want to actually place your resilience dollars. So that's just to give you a brief overview of how we go about measuring vulnerability, because it now provides us with the evidence base to assist us in how we go about determining where to prioritize our resilience building resources. So now I just want to focus a little bit on the idea around the pre-resilience bonds. Now, in the earlier presentation by Sebastian, he mentioned the hurricane clauses that Barbados and certainly Grenada before have now included in their debt instruments. I want to propose a similar type of proposal here, but for actual infrastructure building. And here's how here is the proposal. Now, I want to make the point that we simply don't have enough concessional resources to help us build resilience. We need to, as the Prime Minister said today, there's significant liquidity within the financial sector. How do we now mobilize those resources to help us build resilience? And this chart shows you that we simply don't have enough concessional resources. And we might try to gain access to more concessional resources, but I think our task is really to think about how we actually build a market to get liquidity into building resilience. Now, here is how we do it. And this is why I said this morning, I think that there is market failure as it relates to building resilience. What I think the market doesn't quite understand is that building resilience is actually good business. There's a really high rate of return. In fact, a recent Economist article about 3 weeks ago said that by investing resilience resources into building resilience can actually lead to a rate of return of 7 times your initial investment. And here are just some estimates by various agencies as to what the rates of return could be on building resilience. So how are we going to think about mobilizing excess liquidity for building resilience? I want to say to my insurance colleagues in the room that investing in resilient infrastructure is actually a very good form of investment for you. If you look at the trajectory for environmental disasters, I would say maybe within a decade or two, many insurance companies are going to have to liquidate many of their assets in order to start paying for the claims. Why not invest some of your premiums into the actual asset that you are insuring? And the incentive is there for you to actually ensure that that asset is built resiliently, thereby protecting your own balance sheet and at the same time ensuring that you have resilience and, of course, reducing the likelihood that you will have to pay out on that claim if a disaster was to occur. So I'm just going to go through with you a bit how this could likely to work. Now, when I was thinking through this, I was looking at a typical bond market. What tends to happen in the bond market? Now, a supplier of bonds, so like the government of Barbados would put out bonds, and how are those bonds priced in the market? It's really dependent on maybe inflation expectations and the credit rating of the country. So utilizing those pieces of information, the demanders for those bonds are able to assess what the price of that bond should be. So this slide just shows you briefly what that is. But if we now think about how do we think through if we were to consider having pre-resilience bonds? What are pre-resilience bonds? Pre-resilience bonds are really resources that are going in to try to build resilience ex ante. Now, in addition to the inflation expectations, and in addition to the credit rating of the country or the asset, the demander of those bonds is really now considering the vulnerability expectations. And the problem that we have here is that we don't have a market to allow us to assess vulnerability. This is why this morning I was saying that what we really require is a change in regulatory environment to allow some type of an independent agency to give us a resilience rating which would then provide some comfort for investors to invest in a resilience bond. So how is this likely to work? So take, for example, if we were to have the private sector or even a state-owned enterprise or government issuing a bond, a pre-resilience bond. Financiers look at that bond and say, okay, what are you going to use the bond for? Well, the bond is actually going to be used to build, let's say, it could be resilient infrastructure, or if we're looking at that multidimensional vulnerability index, you might want to improve your resilience on social or even on economic issues. But let's just focus on resilient infrastructure. If, for example, you want to build an airport and you issue a resilience bond to build that airport, now maybe what will be required initially is some type of a bridging loan to build that airport. Now, once the airport has been built, this is where the independent credit rating agency comes in to make an assessment of that asset to determine how resilient that asset has been built. Now, based on that independent assessment, that will determine what the actual price of the bond and hence the interest rate on that bond should be. As I go through here, how does this work? And I think this is where we need to also have a moratorium clause on a pre-resilience bond. Now, this is where I think the incentive comes in. So if my insurance colleagues were to invest in this pre-resilience bond, they have every incentive to ensure that that asset is built as resilient as possible, because the moratorium clause that is included here kicks in if the asset after the disaster becomes non-functional. So let's say, for example, the Grantley Adams Airport has been built to an extremely high level of resilience. And let's say that we were struck by some type of external shock. What I'm saying to the demanders and the investors of that bond is that the moratorium clause would kick in if the Grantley Adams International Airport cannot function immediately after that disaster. Now, as you could imagine, if I'm an investor in that, I do not want that asset to not function, because then the moratorium clause kicks in. So what I'm saying here is that the principles of this pre-resilience bond sets up the incentives in the right way, so that the investor also has a stake in ensuring that the asset is built to as high a resilience as possible, because they do not want the moratorium clause to be kicked in. Now, I think that this approach, if we were to do it correctly, could actually mobilize many domestic resources as well, and perhaps international resources. But I think what's beautiful here is that we can actually democratize investors for national resilience building. And so there's a massive incentive to build to higher codes because of resilience credit rating and that moratorium clause, or as Sebastian called it, the hurricane clause. Now, just try to put together an idea here as to how this credit rating could look like if you were to have an independent agency providing an independent resilience rating of an asset. And this just gives you an idea of what that could look like. So the higher the resilience, you know that your interest on that resilience bond is likely to be less. So there's a real incentive to build to higher levels of resilience. If the credit rating agency comes in and says that perhaps you haven't built it too resiliently based on their independent resilience assessments, then you can expect the interest on that pre-resilience bond to be higher. And so there's a lot of incentives in this mechanism to encourage the greater building of resilience. Now, finally, just before I wrap up, I think that we can do this. Utilizing some type of a digital bond platform. I'm putting this idea out there because there's a possibility for us to democratize investment into building resilience if we were to use the digital platforms for doing this. So imagine, for example, the price of a bond, let's say $100. Anyone with a smartphone can actually go on there and purchase these bonds. And of course, through the platform, we're able to utilize the independent credit rating that is being applied. But also what's important is that these bonds can be traded quite easily, actually reducing the transaction costs. So what I'm proposing here is not only a pre-resilience bond, but also a mechanism to allow the democratization of investment. And finally, I think I have to always end with this slide, because with everything that we've discussed here today, I know that a lack of implementation is a real problem. And how do we go about avoiding culture? Eating resilience and financial innovation for breakfast. And so what we have been promoting over the last couple of years is a few steps in how you go about delivering and implementing ideas so that they come to fruition. And this here just identifies some of the steps that I think will be required in order for us to implement these ideas. Okay, I'm just going to go through that. And Avi, I think that's it. I'm finished. Yeah, thank you.
Thank you very much, Justin. Justin, I was thinking about the credit rating or resilience rating. As you know, when we put credit ratings at the heart of banking regulation, they cause a problem. And I wonder whether you need to do that. Whether this is really on the liability side rather than the asset side, whether you could actually have some kind of first loss insurance. So the insurers with a very limited loss would insure it. And so if they don't think it's resilient, they would charge more for the insurance. But it wouldn't be that they would charge a huge onerous amount because their payout is limited. So it's a first loss insurance. And I think that way you would get a market-sensitive determination of resilience without having an administrative assessment of resilience.
Well, Avi, what I'm attempting to do here, and maybe I've brought a lot of issues to bear, I think the issue that we have in the Caribbean at this point in time is that there's a lot of liquidity. So you have a lot of small savers who have money in their bank accounts. How do we give them an opportunity to have a stake in building resilience? How do we give them a stake in the economy? And so the idea here is that it's not only for large institutional investors to get involved in building resilience, it is also for the small savers to get involved. And this is where I think if we were to have some independent body providing some rating, where we're not looking necessarily for insurance, that could provide us with the incentives to get small savers involved in the building of resilience of their domestic economies. So I think that's why I brought that in there.
Well, which I think we all support, right? And I don't think that is that isn't determined about whether you have a resilience rating, or that in the things that you're investing in, that an insurer has given you some insurance for it to determine how resilient it is. But anyway, that's just a thought. What other questions and thoughts? Clyde.
Good afternoon. Ashley, very much love this idea. The only thing is that I think you have to reduce it to self-interest. How do you bring this down to the very individual that you would like to democratize this whole process? The question here relates to moral hazard. And I'm going to give you an example for us who have dabbled in politics. We go into a shop looking to secure a vote. There's a young man in there who believes that we may purchase some alcoholic beverage for him. He doesn't mind getting drunk once he's not paying the price of the beer or the alcohol. In essence, therefore, we have to find a way to make sure that he doesn't, because we are looking for a vote. Unless we can pass on that responsibility to him, to let him know that he should not be pursuing that path. In essence, then, who bears the cost at the end? We have, therefore, to find a way to make sure, as a government, that the average Barbadian citizen understands the need for insurance, but that they have to bear some costs in order to recognize that it's not a free shop, a free good. So, in essence, we have then to incentivize insurance in order to get Barbados to see it, that they must have an interest in protecting their homes, in protecting the environment, but that as much as we can do as a government, we still have to make sure that they understand, the individual understands that he or she must see this as something that is important to them as well as the wider public. In that sense, therefore, I'm saying that it all comes back to an issue of who bears the cost. In this instance, therefore, it must be the case that the policymakers get the average citizen to understand that he or she must bear some cost. And if, therefore, the idea that you're presented here can reach the average citizen to the extent where they're willing to participate in the purchase of these bonds by way of your technology, you would have succeeded then in getting not just a wider government, but the people to appreciate why we need to go in this direction. And therefore, it is that, for me, understanding that that is the essence and the beauty of what you're seeking to present for us as a government and as a region. I will therefore, and your pyramid that came at the end, which said cabinet prioritization,
Yes.
you need it to point in the right direction, therefore, to get the politicians to understand the beauty of engaging the citizens in a way that ultimately puts the responsibility on them to accept that self-interest here is vital to drive the macro level. So it is a micro thing that builds to the macro, if you appreciate what I'm saying.
Yes, I do.
Thank you.
I mean, I must tell you, Justin, I like the fact that you've gone outside the box. I like the fact that you're trying to address multiple factors. I am, however, a little bit of an old school politician, and after 30 years in public life, I confess to being uncomfortable for the privatization of assessment and regulation, because that's effectively what credit rating agencies, what you're not telling us is obviously that increases the cost of being able to build the trust, and it perhaps leaves me sadder than I may otherwise be, because there was a time when the regulatory agencies that we have, the imprimatur of those agencies would be sufficient to communicate that that which was necessary has been done. And I think that you may have, and others may have, to pause again, because if we keep increasing the costs and the complexity of being able to communicate that something is what it is, then it makes it that much more difficult for us to achieve, especially in small populations with small populations and limited space. So that I wonder whether the existence of the encrypt, which provides a framework for the assessment of vulnerability and hazards, not just at the macro level, and I'd like for the officers to show it to you so that you can review. But to the best of my knowledge, and Ricky, you're here, you've seen it, haven't you? And it goes down, I think they said, to every 100 meters. Yeah? Now, anything that can drill down to 100-meter units and that takes all the data on an island as small as this is likely to give you strong data. And my reference to the events of 1949 or 1952 or 1916 or all of them just tell us that there's a lot more data there than we give credit for, because we are arrogant in this generation and believe that data only really started being collected by us. So I wonder whether the potential increase in bureaucracy and costs cannot be eased or minimized by having access to those planning tools for which millions of dollars have already been spent, and for which, therefore, assessments can be made with a better sense of probability than currently exists if we were doing it without it.
Sure. PM, when I say here that there's...
And on top of that, the legislative obligations of the regulatory agencies to do that which they have committed at law are required by law to do. Because really and truly the codes and the different things create that obligation for a lot of the resilience in the construction that we are hoping to achieve.
Yes, no, I agree. This resilience credit rating, I mean, it's for a lack of a better term, it does not have to be private sector led. It can, of course, utilize existing structures within the public sector, as long as they're credible and to be seen as being independent as well, because I think that's also quite important. So, I mean, this of course is just the start of the concept, and I think yes, some of these details can of course be worked out.
I think the concept of also being able, and Avi put the question of first loss for the insurance company, but the concept of being able to sap up some of the excessive liquidity, which regrettably continues to be all about the region, is a real issue. And we have to find a way of being able, and I suppose it is the bridge of trust. Yeah. So how do we get the population, and how do we make it easy for them to risk a portion of what they have without being completely compromised? And that's why the simplicity of what you're trying to achieve in principle is attractive. The question is, can we achieve it without significant bureaucracy and costs?
Yes. Well, I certainly, yeah, okay.
Do you want to
respond? Yeah, I certainly think it can happen, particularly in this digital age. If we were to able to utilize some type of a digital platform, it would make it very simple.
Ravi?
I think the bond can work under two conditions. It has to be part of a collective investment arrangement. It can't be a bond just by itself where individuals participate, because then you have socialized risk that they genuinely don't understand, rather than institutionalized risk. The second part is an insurance wrap can work, because we currently do it for construction right now, and that would be like in the background, and that cost is just amortized into the coupon over the tenor of the bond. So it's a matter of starting small, because but under those two conditions, I can see an instrument like this working. But there was a point I wanted to